Hello everyone, this is Devang here and I welcome you back to another episode in my series of Costology. Costology is my series of short videos where we talk about certain interesting terms in my favorite subject of costing. Yes, so before we proceed with my term for today, let me remind you that my regular classes, my regular batches are already running on Unacademy platform. Yes, only on Unacademy platform, and you can use my code Yashas Live to get some attractive discounts on your subscriptions. You need a plus subscription for that. Use my code to get some attractive discounts on my subscriptions. Okay. In fact, right now we are having very attractive discounts running up for you. Well, look at this. You can use code Yashas Live. You can use my code Yashas Live and get 20% discount on all your CA Final subscriptions. Offer valid till 29th of July only. So hurry now, rush now and get your subscriptions today. Right. Okay. Now, my term for today is a term called shutdown point. Shutdown point. Now, what exactly is shutdown point? This is used again at many places in costing. This is a general tool in many calculations of costing, right? Mostly this is part of CVP analysis. But what does this mean? Well, shutdown point is a level of sale. It is a level of sale below which it is better to shut down my business, but shut down temporarily rather than continue with higher losses. Break even point. What is interpretation of break even point? Break even point indicates that if your sales is expected less than BEP, then you will incur losses. Now, if your estimate is really less than break even point, then you know that you're gonna incur losses. Now, just because you're gonna incur losses, does it mean you will shut down business? No, because if you shut down business, then you might incur more losses because fixed cost you will have to still bear, right? So shutdown point is another level which is always lesser than break even point. See, break even point, below break even point you start incurring losses. Below shutdown point you start incurring losses more than the shutdown loss. So shutdown point is the level below which it is advisable to shut down the business because continued business gives you more losses. Now this entire concept of shutdown point will come into picture only if there exists some fixed cost which is avoidable by shutting down. See, by shutting down the business, you should get some benefit at least. Yes, what will be the benefit of shutting down business? See, if you shut down business, your sales is gone, your variable cost is gone, your contribution is gone, but fixed cost will still remain. So shutting down the business should give you some benefit in terms of saving some fixed cost. So if there exists at least some fixed cost which is avoidable, only then shutdown point concept will exist. That's my second rule here. Shutdown point. The concept of shutdown point will exist only and only if there is at least some fixed cost which is avoidable by shutting down. Okay? So my calculation of shutdown point is a simple formula. Directly, I'll explain the formula. It says shutdown point is my avoidable fixed cost divided by contribution per unit. So shutdown point is simply avoidable fixed cost divided by contribution per unit. See, normally break even point, how do you find? If I compare this with the formula of break even point, देखो, break even point is total fixed cost divided by contribution per unit. Yes, break even point is total fixed cost divided by contribution per unit, while shutdown point is not total fixed cost. Why so difference? Because they go break even point is the point where you want to avoid entire loss. You don't want any loss, so you want to recover entire fixed cost. But in case of shutdown point, you know that your estimated sales are going to be less. You know that some fixed cost you will be able to avoid, but remaining fixed cost you know that you have to bear it. Yes, so imagine out of your total fixed cost, there are two parts, avoidable and compulsory. Out of your total fixed cost, imagine there are two parts. One is avoidable fixed cost Another is compulsory fixed cost. Now you know that compulsory fixed cost anyways you're gonna incur. Whether you shut down or whether you continue, compulsory fixed cost anyways you are gonna incur, it will be incurred in any case. Whether you shut down or whether you continue, that compulsory fixed cost is not relevant to your decision. What is relevant is the avoidable fixed cost. You continue business only if you are able to recover at least the avoidable fixed cost. If you are able to recover at least the avoidable fixed cost, then you continue, otherwise you shut down. So to recover avoidable fixed cost, how much units do you need? For recovering only the avoidable fixed cost, how much units do you need? That is shutdown point. To recover total fixed cost, what units you need? That is break even point. Yes, but right now my discussion is that how much units do we need to recover at least the avoidable fixed cost, right? So to recover avoidable fixed cost, I need avoidable fixed cost divided by contribution. This much units is what I need. If you are able to get this much units, then you continue. If you are not able to reach this much units, then it is better to shut down and therefore avoid that avoidable fixed cost. Yeah. If your sales is expected less than shutdown point, then it is better to shut down and save that avoidable fixed cost. For example, say my normal fixed cost is 1 lakh. After shutdown, my fixed cost will still remain 40,000. So how much is avoidable? Therefore, avoidable fixed cost is balance 60,000. Yes, so 60,000 seems to be my avoidable fixed cost. So shutdown point will be as per the formula. 60,000 is avoidable fixed cost. How many units do you need to recover this 60,000? Well, how many units will you need? Your contribution is 20 per unit. So how many units will you need? 60,000 divided by 20, 3,000 units you will need. Divided by 20. Yes, 3,000 units minimum you will need. So if you expect your demand to be more than 3,000, then you continue doing business. If you expect your demand to be lesser than 3,000, it is better to shut down. Done? That's our concept of shutdown point. This concept is used again at many places. It is applicable in CA intermediate, also applicable at CA final level. It is widely applied at many places in the subject of costing. It is not particular to any specific chapter. Done? I hope this gives you some sense into the concept of shutdown point. Until next time, thank you very much. Bye bye.